Hello, personal finance students. Welcome back. We are looking at Unit 4, the second part of Unit 4, talking about insurance. So in the previous videos, we talked about banking, and now we're going to look at insurance. Let's dive right in. So, insurance. It's easy to buy things we like, but what about buying security to protect those things? This is kind of like an introduction to what insurance actually is. So insurance is a form of risk management. So if there's maybe a fire or a car accident or a robbery, insurance helps replace the items that were maybe damaged or lost during those incidents. It's easy to not buy insurance. So a lot of people see insurance as, oh, I don't need it. A lot of times it's not required by law. Sometimes it is, and we'll talk about that. But it's kind of easy not to have it because it's an extra payment that you're making just in case something happens. And so it's easy for people to be like, that will never happen to me. But accidents do happen, and when they do, are you prepared? So let's get a little bit more specific about what insurance is. So again, it's a form of risk management. And by paying the premium for an insurance policy, the insurance company agrees to protect you. So let's look at what those terms mean. So a premium is the payment you're going to make in order to have that insurance. So usually this comes in the form of a monthly or bi-yearly or yearly premium, which is the chunk of money you're going to pay the insurance company in order to provide you with insurance. And the policy is the specific type of insurance plan that you're paying your premium for. So it could be a health insurance policy, a car insurance policy, a life insurance policy. There's lots of different policies out there. And you can insure just about anything. So you probably have heard of the typical insurance policies like car, home insurance, life insurance, health insurance, but there are a lot of, again, you can kind of insure just about anything. So again, athletes might insure against their injuries, so they could insure like their legs or their arms, depending on what sport they're playing. And if they get hurt and they're no longer able to play that sport, maybe they're a professional athlete and they were getting paid to play that sport, and then they get hurt, insurance will compensate them for the salary that they're missing out on if they have insurance, again, against their injuries. Doctors might insure their surgical hands, so maybe they have insurance on their hands so that if something were to happen, they could no longer perform surgery, they would get compensated by insurance. Again, they would get paid by insurance for maybe that salary that they're missing out on. So, or then this is probably what you're more familiar with, is insuring things against losses that could result from accidents, fire, theft, illness, or death. That's kind of the more common type of insurance. And so again, an insurance company will compensate or give you money for losses within the limits of the policy. So depending on the type of policy you have and what that policy is covering will depend on what you get compensated for if something were to happen. So the policy holder, which is you, may be responsible for deductibles or co-payments. So again, some more vocab words that we need to look at. So the deductible is the portion that you are expected to contribute before the insurance kicks in. So maybe if you do get in a car accident, you have to go to the hospital, and your health insurance says, well, you need to cover the first $1,000 of costs that you acquire while you're at the hospital, and anything over $1,000 will cover. So that's how how the deductible works. So if you have a $1,000 deductible, you have to pay that first $1,000 before insurance kicks in and covers the rest. So if it was, maybe you got racked up a $5,000 hospital bill, so then you would pay a thousand of that $5,000, and insurance would cover the remaining $4,000. So it really helps when insurance does kick in. That way you're not stuck with that whole $5,000 payment. And then insurance companies a lot of times require a co-payment, which would be your upfront costs that you agree to pay. So again, like with health insurance, maybe you've gone to the doctor and you've heard your mom or dad mention, oh, we need to pay this $30 copay or $35 copay. That just means it's an upfront cost that you agree to pay for like trips to the doctor. That copayment is most common with health insurance. Okay, so but again, there are different types of insurance. We have auto insurance. So this is going to provide financial protection against damage, loss, or theft of your car. It could also cover medical expenses for those injured in the car or in the car accident up to a certain amount of money. We have full coverage car insurance. This type of car insurance is not required in every state, but it could be required by your bank. If they've given you a loan to buy a car, they might require that you have full coverage car insurance. And with full coverage, it covers you and others involved if the accident is your fault. So keep that in mind. And it also covers most other damages and loss to the vehicle. So that's full coverage car insurance. We also have what's called liability coverage car insurance. And this type of insurance is required in all 50 states. So with liability coverage, this is coverage that means you will cover damages due to injury, death, vehicle, and property resulting from your actions in an accident. So if you were in a car accident and it was your fault, and the other person gets injured and needs to have some medical things done, your insurance company would cover their medical bills. So liability insurance, again, is required in all 50 states for you to have. And that very last one says, protects others from you. So again, it's insurance that you need to have in case someone else gets hurt because you were at fault. We also have homeowners insurance. So this is a homeowners policy is a combination of 3 types of coverage. There's dwelling, personal, and liability. So dwelling would be if something happens to your home, then insurance will cover the cost to repair or rebuild your house. So if there's like a natural disaster and you need some work done to fix your house, dwelling insurance would cover that. Then there's personal. If the contents of your home are damaged or stolen, insurance will cover the value of your possessions. So that's why in one of these assignments, I think we'll take inventory of everything that you own so that if something were stolen or damaged due to whatever reason, you could get the value of those possessions covered. And then there's also liability homeowners insurance, which will pay your legal expenses if someone gets injured on your property or if your home causes damage elsewhere. So for instance, maybe a tree from your yard fell on your neighbor's car. Liability homeowners insurance would help cover the payments of that car. And then renter's insurance kind of goes with homeowners insurance. It both like kind of protect the dwelling that you live in. And with renter's insurance, it protects your personal items. So it can also help with temporary housing and liability protection. So if you are maybe you're in the process of looking for another place to live, they can help with temporary housing. And I know this is getting cut off down here, but it says medical expenses, lawyer should someone get hurt at your house. So again, if you have renter's insurance and someone gets hurt at your property, this insurance would help cover any medical expenses. Okay, now we talk about health insurance. There are several different types of health insurance plans. The ones that our text covers and these are kind of the most popular. We have fee-for-service plans. These types of plans, you're treated by a physician without referral. It pays a percentage of reasonable and customary charges. So as long as you're not going to the doctor all the time, it will cover those charges. There's an out-of-pocket maximum, which is like a deductible. So there's a certain amount that you might have to pay before insurance kicks in. And then there's a lifetime limit on what they will pay for each person. So there's an out-of-pocket maximum for you for how much you will pay before insurance starts. But then there's also a limit on how much insurance will cover once over your lifetime. We also have high deductible health plans. These have lower monthly premiums, But there's an annual deductible that must be met before benefits are paid. So again, there's that deductible there. And so maybe you have a higher deductible in order to get lower premiums. And we'll go into this more during our Class Connect sessions. But maybe you don't go to the doctor that often. So you don't, you can really lower your monthly premiums because you don't need a lot of coverage because you don't go to the doctor very often. But then, yeah, if something were to happen, you would have some good coverage in place. Okay, more health insurance plans. We have the HMO, which is the Health Maintenance Organization. So an HMO is something that's provided usually within the business that you work for. An HMO helps control cost, amount, location, and types of treatment. So with an HMO, you're only allowed to see certain providers or certain doctors under that plan. It usually requires a copayment. So when you go visit the doctor's office, you have to make a copayment. And then you're also assigned to a primary care physician. And with this physician, if you needed special treatment, they would refer you on to whatever special treatment you needed. Non-participating providers equal no payment from HMO. So if you would choose to go see a doctor outside of your HMO providers, then that would be out of your own pocket. So they only covered certain doctors. They kind of limit the doctors that you can go see for whatever illness you're having. Then there's also a PPO type of health insurance. This is preferred provider organization. This is kind of a combination of HMO with a fee-for-service plan. Again, there's co-payments. You can use in a preferred provider organization. You can use providers that aren't on the plan, but there's also a lifetime limit for what the PPO will cover. So that was kind of like our fee-for-service plan. There's a limit on how much they will contribute. Okay, moving into life insurance now. Life insurance provides financial coverage upon your death. So if you were to die, this life insurance would pay money or leave money to your beneficiaries or those people that you listed that you want the money to go to. So this money leaves money to family for funeral expenses, maybe if you have outstanding loans, maybe to cover for your lost salary. So if it's a parent that passes away, maybe their life insurance policy will cover their salary for that year, just so that the family can continue to live like they were. The amount of coverage depends on the financial responsibilities and sources of income. So when you go to set up life insurance, you want to look at how much income you're bringing in, how much debt you have, because you don't want to burden your family with your debt, your living without your income. And so you get life insurance in order to if you were to die, all those things would be paid off and not a burden on your family. So some things you'd want to consider when kind of assessing how much life insurance you might need. Consider ongoing expenses. So maybe if you have children in daycare, student or kids in college, if you have a mortgage, or if you're in retirement, those will all be expenses that you need to consider. Consider the medical bills, burial costs, estate taxes. And I know none of this is fun to talk about, but it's really important that we don't leave our families with this financial burden if we were to die. And financial experts suggest your life insurance policy should pay a benefit, so a sum of money, to your loved ones equal to 10 times your annual income. So if you make $500,000 or $50,000 a year, you should have a life insurance policy that covers 10 times that amount in order to help your family continue to live with some source of income for a while, cover your expenses, cover your medical, funeral costs, whatever it is. So I'll stop here for this video and we'll pick up on some more about life insurance in the next video.